extremely handsomely attired set of male anchors that we have today. It is Independence Day celebrations in CNBC TV18. And I think for the moment we are celebrating independence from the fears of yuan devaluation.
And yes, and there's quite a bit of celebration in our newsroom as well because of the way everyone's dressed up. But the two of you are wearing the exact same color.
Oh yes,
that's quite
color coordinated.
I'm the odd one out, but
today it looks like we can make mistakes because everyone's only going to watch them in.
Oh yeah, that's true. That's true. I agree completely. But you know, it's been. We don't have independence from the fact that the FIIs have been selling our markets. So yesterday as well, there was quite a bit of a sell figure, more than 600 crores or so. But what's the mood like as we head into trade this morning, Lata?
Well, I think the big period of volatility is over and ends with this week. The FII sell figure is also receding. More importantly, the way in which the yuan has been set. 4 days back when the first devaluation happened, it was a minus 1.9% that it was set. Then it was set 1.6% lower. Yesterday it was set about 1% lower. And today it is flat. It's set almost at yesterday's closing levels. So clearly a bout of depreciation which the Chinese authorities wanted has been done for the moment, or so it seems. So there is peace and calm to that extent in the currency markets. Yesterday and today, for the last 24 hours, Asian currencies are largely calm. I would assume that the long-short trade that was playing against the Indian rupee, the Indian rupee was long versus almost all emerging market currencies for the past 12 months. That was the favorite trade, you know. Short won, long rupee, short ringgit, long rupee, short euro, long rupee. And beyond a point when those currencies fell, all those short-long trades were very attractive to be wound up. And that perhaps played out in our markets yesterday. Today, perhaps a little more downtick in the rupee may be there because yesterday actually it went to 65.20 at about 10 to 5 just before we closed, and then, you know, as always the Reserve Bank must have yanked it up. A little bit of downside is perhaps left. I don't think there'll be too much. 65.20 is seen by some technical people as a support. Some people even look at 65.10 as a support. So it might stabilize at these levels, and I think we are back to the range. In terms of good and bad news, the parliamentary session was a washout, but I think it was increasingly getting discounted in the market. The GST constitutional bill is going to rankle. You speak to any foreign investor, domestic investor, India Inc., it is the GST. Everything else people could take in their stride, but it was expected that the GST, since it was everyone's baby, would perhaps get by. So that's going to rankle for a bit, but I don't think that is enough to take the market down, simply because the liquidity argument, which we were making all the while up until the Chinese yuan devaluation theme came to dominate headlines, the massive amount of domestic liquidity is still there. So any further falls in the market will have to take cognizance of the liquidity argument.
Well, yes, that may be true, but you know what, Lata, while the headline index may be flat and range-bound, there's quite a bit of pain beneath the surface. I mean, if you look at what's happened this week, the Nifty is down 2.5% this week, and lots of heavyweights, whether it's SBI, whether it's Tata Motors, whether it's Vedanta, they've lost about, 8 to 10 to some even 20% this week. So there's quite a bit of damage on individual stocks.
No, there is no taking away from the fact that there is a little bit of a shudder that runs through the public sector banks, in fact the entire banking space, because the Chinese devaluation threat remains, and the fact that for a longish bit we are not going to see steel prices recover to even $400. If the Chinese are devaluing and using the currency to prop up stimulate their local economy, clearly there is a fear that the Chinese economy is weaker than we thought, and therefore to expect that, okay, this is the low in steel prices, $340, $330, and it gets 400 by the year end or a little better, that mood has vanished. Now it looks like for a longish bit we are going to have lower commodity prices, and look at the way crude fell yesterday. So that is a separate theme, that global slowdown theme that's playing, and that is going to impact the banks. But my point is that this mid-cap fall that we saw in select counters, my sense is the liquidity argument is still there. The domestic liquidity is coming. The Sundaram mutual funds and the Franklin Templetons in our Inside Chennai shows were telling us just that there is this domestic liquidity which is going into mid-cap stocks. So, Anuj, that's exactly what I wanted to ask you. Do you think that the mid-caps will also now find their feet? Yes, it was high beta and therefore it fell more, but maybe they also find their feet?
Morning, Latap. I think for that question will be answered if we first get an answer on what happens to the market next and whether we have seen the worst of it. And I tell you one thing, we'll read out the quote from Chris Wood, and I think he has hit the nail on the head. Right now, what has happened is that the yuan move has been just a 2-day move, but it's going to take many days for the markets to recover from this shock. The markets will have to see the evidence that okay, this is the worst of it. And then I think the market makes a further move from here on. Till then, the market trend has changed. The market trend actually changed on Monday. It's been a bad week for the market. You saw on Monday the Nifty went to 8600, and from there it slipped 8620, 8630. It slipped, and since then it's been a sell-on rally market. Every rally was sold into. In fact, Sonia, yesterday also there were 2 or 3 rallies. They were all sold into. We spoke about the first thing in the morning that the bears would use that rally to sell. That's exactly how it panned out. Then there was second rally because of European markets. That was also sold into. Somehow the bank Nifty managed to outperform because of rate cut hopes. But I don't know how much of a hope that is going forward. The big hope today is that the big ferocity with which FIs were selling, that has come down. Yesterday, FIs sold only about 600 crore. I'm saying only because the day before was 1800 crore. 600 crore in itself is not a small number. It's $100 million, right? But DIS bought that, so that's good news for the market. And one thing which is really helping the market now is that the market has got distinct sign of leadership from 2 erstwhile leaders, IT and pharma. IT, for example, clearly, yes, yesterday there was some profit booking in TCS and a couple of other stocks, but look at the delivery-based buying yesterday in Infosys, almost 400, 500 crores. That's telling you that at least 2 sectors are willing to take the market higher from here on. So that's at least going to support the market, even if there's problem in stocks like Tata Motors, Larsen & Toubro, Bharti. And even if you take a look at the F&O data yesterday, there was a bit of index future selling, about 230 crores, but that was mainly on account of long unwinding, not as much on fresh shorts. But the data point I am most concerned about, or the bull should be most concerned about, is the FI buy number in index options. Yesterday, again, almost 1,000 crores of index options buying. And I was just looking at the data, it's downright bearish. You cannot ignore that, ignore this data. There was huge amount of put build-up. 51,000 index puts were added net. I mean, if you were to look at the unwinding of puts written and fresh put buying, 51,000 fresh put build-up, and that too, most of that at 8,100 put. Now, sometimes these are portfolio hedging, sometimes these are just random moves. But for a market which has now 2 weeks to go for expiry, this kind of build-up, accompanied by this kind of volatility that we have seen, normally tells you that a breakdown is around the corner. Now, keep in mind, we have had a false breakout, and for all you know, this could be a false breakdown, and the market well still remains in the range. But as of now, the risk of this market going to 8,200 or 8,100 is extremely high, and that is if the Nifty fails to defend 8,300. And normally, with the kind of week that we have had, Fridays normally tend to be a bit bad or a bit ugly, especially in the second half. So I won't be surprised if today all rallies are sold into. The thesis changes if, of course, the global markets become a bit more sanguine and believe that the worst is over from yuan side of, but that normally takes 3 or 4 days of evidence, not just 1 day of evidence. So my sense is that today you should be prepared to see some more red on the screen at some point during the day. And for the mid caps, I take your point. There's a lot of pent-up demand. You'll see a lot of buying, but it will be restricted to quality names. The kind of rally that you had seen over the last 5 or 6 days before this sell-off started, that rally is getting out of the way, which is healthy for the market. You will see now buying in select pockets. Oil marketing companies, for example, may see some buying again up from lower levels. They've corrected quite a bit. A couple of other stocks may see some buying, but it will be in quality names. For overall market, there's a risk that we might have a breakdown because the breakout clearly was a fake one and the market failed to sustain above 8,600.
Indeed. In fact, the market is making that distinction of the men from the boys in the mid-cap space. Yesterday, we saw, all the ADAG stocks, all the JP Group stocks succumb to intense selling pressure. And by the way, it's not just our own markets that are volatile. If you look at what happened overnight in the US markets, the Dow had a 150-point intraday swing before closing flat. But here's what you'll get to see on the show. We're celebrating, it's tomorrow, but today we're celebrating the 69th